Hello there, Prof. Aram here, and in this video we are going to attempt in finding the optimal capital structure. So let's get to this. What we've learned so far implies that capital structure matters, right? For example, we know that adding debt will decrease the taxes paid through the deductibility of the interest, right? But also it will increase the shareholder risk by redistributing the business risk to the remainder of the shareholder when you recapitalize your capital structure. And both of these will affect the valuation of the firm. So going back to the trade-off theory of the capital structure, we see that there is an optimal level of debt or debt to equity ratio that maximizes the value of the firm and minimizes the cost of capital, right? In other words, the trade-off theory suggests that there is a trade-off between the benefit, between the tax deductibility of the interest, the benefit of debt, and the cost of financial distress, the cost of adding more debt to the capital structure of the firm. So we need to manage this trade-off. So how do we find this optimal level of capital structure, the D star or D to E star in this graph, right? Let's look at an example. Here we have a firm that has zero debt, right? Meaning that this is an all equity firm for the moment, right? So the beta for this firm is 1. This is the unlevered beta. This is the beta of the firm when they have zero debt and all equity. The risk-free rate in the market is 6%, and the market risk premium is also 6%. And if you use CAPM to calculate the cost of equity for this firm that has zero debt and is all equity, the cost of equity is going to be 6% times the unlevered beta times the market risk premium, which is 12%. Okay, and because this is an all equity firm and they have zero debt, this cost of equity is going to be the same as the cost of capital for this company. So the cost of capital is the same as cost of equity, which is 12%. We also assume that we have a 40% tax rate here. Also, the expected free cash flows for this firm are $30 million, and we assume a zero growth rate. So every year you're going to receive $30 million. So instead of having this as your valuation formula, basically this will become a perpetuity, meaning that you will receive the same 30 million every year, right? Instead of a growing perpetuity, you just have a level perpetuity. Okay? So the present value of these future cash flows, the $30 million each year, will represent the value of the operations for this company, right? So you do 30 million in cash flows discounted by the cost of capital of the firm, 12%. The value of the firm, when it's all equity and zero debt, is $250 million. And we are going to assume that there are no other sources of, there are no preferred stocks or short-term investments that the company has, right? And the number of shares outstanding is going to be 10 million shares. Okay. So the first step in determining the optimal capital structure or finding out at what level of capital structure we have value of the firm maximized and the cost of capital minimized is to find out what are the costs of debt that you will incur at different levels of capital structure. So for example, of course, if you have zero debt, your cost of debt is going to be zero. But let's say you are asking your investment bank if you want to have 20% debt in your capital structure, what would be the rate that you can get? What would be the cost of debt at 20% level of capital structure, and so on and so forth. As you can see, when you keep adding to your debt, when you keep increasing the amount of debt in your capital structure, the cost of debt is increasing. So at 20%, you have 8% interest rate, but at 50%, you have 12% interest rate, right? So, and also we're going to assume that if the company recapitalize, they're going to use the proceeds from the issuance of debt here and use that to repurchase shares of the company. Okay, so we are recapitalizing the capital structure of the firm. We are changing the mix of debt to equity on the right-hand side of the balance sheet. So the first step in this situation is to calculate the levered beta. As you know, an increase in debt ratio also increases the risk faced by the shareholders, which will affect the cost of equity, right? That means that, and you know that the cost of equity depends on beta, and beta increases with the financial leverage, okay? This Hamada formula or Hamada equation specifies the effect of leverage on beta and shows how increases in debt to equity ratio increases the beta of the company, right? And just get rid of this. Okay, so here we have levered beta equals the unlevered beta, the beta of all equity firm, times, there's going to be multiplication here, times 1 plus the 1 minus the tax rate, 40% here, times weight of debt over weight of equity, right? So this is your debt to equity ratio, okay? So given our information, beta of the levered company, when you have, in this case, 20% debt. So we are going, this example shows the calculations for 20% debt, 80% equity. So at 20% debt and 80% equity with 40% tax rate, the beta of the levered firm is going to be 1.15, right? And then we're going to use this new beta to calculate the new cost of equity, which is 12.9. It is, I mean, we've already covered this, but as you keep adding debt to your capital structure, of course, cost of equity will increase because the risk that shareholders are accepting now is higher than what it was in an all equity firm. Okay, so the cost of equity will become 12.9%, and then we can use the weights that we have. So in the new setting, we have 20% in debt, we have 80% in equity. Cost of equity we just calculated is 12.9%. This 8% is provided by the bank or the investment bank that is going to help you issue bonds, right? So we know that the cost of debt, before tax cost of debt, is 8%. And then, of course, we need to multiply that by 1 minus t to get the after-tax cost of debt, right? And given that, you're going to find 11.28% for the cost of capital of the firm. So we're going to repeat this process for 30, 40, and 50% debt ratios, and then come up with this table, right? So in this table, you see that, okay, we are calculating this is what we just did for 20%. The cost of capital is going to be 11.28%. For 30% is going to be 11.01, and then so on and so forth. And as you can see, when you calculate different weighted average cost of capitals for different levels of debt, a picture emerges. This is your answer, right? You can see that at 30% debt to equity ratio, or when you have 30% in debt and 70% in equity, your cost of capital is minimized, right? So basically, we are looking at this picture, right? So at this 30% debt, 70% equity, or 30% debt in the capital structure, you see that the cost of capital is at its lowest, right? So we can say that this is our optimal level of debt or optimal capital structure at 30%. Okay, you can also use the same information to find the value of the firm. So we already know that the cash flows are not growing. So now you do 30 divided by the new cost of capital at 20% debt, right? Which, as you can see, it leverage, increasing in leverage will increase the value of the operations for the company, right? So out of this 265,096,96, 5319 is your debt and 112.77 is your equity, right? So you can see the same answer here. At 30%, because your cost of capital is minimized, your value is also maximized, right? So we can determine, this is how we determine the optimal level of debt to equity ratio, or optimal level of debt, or optimal capital structure for a company. Okay, I hope you find this video useful, and thank you for watching.